Good afternoon. I'm John Hickey with Plastics News. Welcome to the third in our ongoing series of fireside chats fueled by M. Holland and produced by Plastics News. We are proud to bring you this streaming event where you'll hear live, casual conversations with leading experts on a variety of significant topics to the plastics industry. We will be streaming this video broadcast live via YouTube from downtown Chicago, and you will have the opportunity to ask questions in real time and receive on-air responses. To participate in this live chat, you must have a Google account with an associated YouTube channel. If you do not have a Google account, you can either create one or add a YouTube channel to an existing account. You can type questions in the live chat box to the right of your screen. Today's chat looks at the promises and pitfalls of mergers, acquisitions, and strategic growth. We've entered yet another busy year for buying and selling among plastics processors. You can witness much of that activity just by looking at the pages of Plastics News each week. Many of these transactions have moved the needle, with companies being sold at high multiples and with new owners adding growth and making strong competitive advances. The Fireside Chat will take a deeper dive into the financial world and its greater impact on the industry today. Today we have Dwight Morgan, Vice President of Corporate Development for M. Holland, and unfortunately Lou Longo, Global Services Partner for Plant Moran, was detained by the weather here in Chicago. Jeff Mengel from Plant Moran has been gracious enough to stand in for Lou. Dwight Morgan joined M. Holland in February 2015. He is a member of the company's executive leadership team and is responsible for strategic planning, M&A, and business development processes. Dwight has vast experience in mergers and acquisitions. He began his career in plastics with M.A. Hanna Company, a predecessor to PolyOne Corp. In 1998, he formed Excel Color Corp., a producer of custom formulated color and additive systems. When Excel Color was sold to Tecmer PM in 2008, Dwight continued to run the company. In 2013, he joined the Composites Group, a leader in thermoset composite compounding and manufacturing, and participated in integrating 3 business units and preparing the business for its eventual merger into Citadel Plastics in November 2014. Jeff Mengel, a Plant Moran's national practice leader for plastics, he works extensively with manufacturing and distribution companies and has a deep knowledge of private equity groups. Jeff has more than 30 years' experience in operation and strategic planning, as well as tax planning, preparation, and financial statement audits, serving the firm's M&D clients. Since 1995, Jeff has conducted the North American Plastics Industry Study, which benchmarks performance metrics of successful and struggling plastics industry companies. He has extended this level of benchmarking to the food and beverage industry. Now that I've introduced our esteemed presenters, I'd like to turn this fireside chat over to Dwight Morgan of M. Holland Company.
Thank you. And Jeff, thank you for being here. I am really looking forward to this conversation. You come from Plant Moran, and you have extensive experience, and you've seen both the buy side and the sell side. You've had experience with strategy. You've had experience with due diligence, integration. So I think this is going to be a great conversation. So my first question, I'd like to sort of cover 4 topics here if we can touch on them over the next hour. First, I want to just talk about the overall market for M&A right now. Then I want to try to touch on international and some of the nuances of expanding internationally through strategic moves. Then let's talk a little bit about the risks and pitfalls of integration and then the due diligence process if we can do that. So what are you seeing in the overall M&A market?
The market's been strong for several years coming out of the Great Recession. So we've had a number of transactions we get involved with in due diligence. We have our sister company, PM Corporate Finance, that gets involved in the buying and selling of companies. And they've noticed that it's a slight uptick this year from last year with 160 odd transactions in the first half of the year in the plastics industry. The growth continues to be fairly strong. And I've seen it as well in assisting with due diligence and a number of transactions that are going on. And just today we have probably half dozen transactions that we are being involved in one form or another. So it hasn't abated. And as a result, I'm seeing some strong valuations. And as a matter of fact, coming over here today, I had a call from an individual who wanted to know, what's the multiples for this kind of a company? And so it's easy question. It's not an easy answer because there's so many other factors to consider. But I'm surprised what the multiples are at.
Yeah, I the stats I've seen. This is like this will be the 12th year in a row that we're paced in the plastics industry to do over 300 transactions, which is huge. In terms of valuations, what's driving the valuations?
Well, there's a few things. Number one, the profits are doing pretty good in the industry. They've slowed down a little bit in the last year or so, but the industry actually has performed very well. So there's some people are interested in monetizing those good years. Private equity is the big driver, though. Private equity has democratized the selling of companies, and it used to be, you sold to friends and family, you sold to your management team. Now there's this whole new group out there with hundreds of millions of dollars, billions of dollars available to support transactions. And we're not talking about a few. We're talking about, I guess there's a couple thousand different private equity funds out there. And that's been a huge driver in it, but also strategic buyers. And I know your company's been involved in some transactions, and I looked at things. It's a way of growth. So how do you get to that next level of growth, and what do I have to do to get to that level? Sometimes it's easier to buy it than it is to build it, particularly if you want to go into a new industry, a new customer mix, a new geography. Those things, so from a strategic standpoint, it might be in there. There's all sorts of reasons why people would be interested in buying. And I know a lot of people say, okay, give me a multiple. What's the multiple that people are going at right now? It's all over the map. I get surprised when I start seeing some of these that are double digits. I find it hard to believe that would be the values in some of these. But it's common to see north of 6 multiples right now, and it's uncommon to see below 6.
Yeah, I think there's several things going on with the multiples and the valuations right now. I think they're high because there's a lot of money on the sidelines. As you mentioned, the private equity companies have about over $700 billion of dry powder right now. And when you're in private equity, you have investors giving you that money, and you're expected to invest it for a return. So they're under great pressure to invest. It's relatively cheap money. Interest rates are still quite low. Corporate or organic growth in much of the economy is relatively slow. Mm-hmm. So it is driving valuations. But I think another factor is just the quality of the assets. After the Great Recession, a lot of the activity was firms that were struggling because but the firms that are being sold today, they survived that difficult time, and they're good quality companies. So I think that has something to do with it. I think it's probably good to talk a little bit about some of the factors, though, that affect those multiples. I know one is company size. A lot of the private equity funds and even strategic buyers will have certain thresholds. We're not going to look at anything with less than $5 million of EBITDA or something. So the smaller businesses, it's a much smaller market, and therefore there's a discount relative to some of the larger businesses. What other factors are going to affect the valuation?
Well, it's interesting. As I mentioned before, we do the North American Plastics Industry Study, and in there we actually do a value rating where we take companies. Now, we're not giving it a valuation. We're not calling it a valuation because there's too many other things that have to be considered. But a value rating so you can kind of compare where your company is versus others in the industry. And first and foremost, cash flow. What's my cash flow after my CapEx? So give me my total cash flow, EBITDA, minus my CapEx, and how much am I developing, maintaining? So that would be the biggest component. But growth is another component. Am I growing? Sales growth, that's a huge item. Am I stable? Do I have a stable environment? Is my balance sheet flush? Do I have seasonality in my business? And then customer leverage as another one. So there's a good news and bad news with having a single customer. The good news is they're easy to manage. The bad news is they have all the leverage.
Got the risk, yeah. So an added thing I think to consider in valuing a business is the synergy you expect to receive, because you can afford to give some of that synergy up. I remember years ago with Hannah, we went on an acquisition spree because we had been this mining company and we had a huge slug of tax loss carryforward. 250 million of tax loss carryforwards, and they had to be used up by a finite period, and so we needed good, strong U.S. earnings right away, and we were able to pay a premium because we had this great tax shelter. So I think when you're evaluating an acquisition, you have to sort of take a look at the synergy you hope to receive, the value of that, and are you willing to give some of that up in acquisition premium?
Particularly with strategic buyers, there's just so I was been involved in the plastics industry since the 90s, and in the early 90s there was a lot of consolidation for the sake of consolidation. Increase asset utilization, you make more money. That is not necessarily what it takes. You have to have a competence that you're increasing. If I can increase that competence, not just asset utilization, because assets are relatively cheap to buy. It's the competence and having the market know that you have that competence. That's much more difficult. But how do I get additional competence? How do I get this additional skill set that I need to have in a new technology or a new process altogether? I want to go from injection to blow molding and have a blow molding component in there. I want to go to a new geography. I need to address where I am in the United States or internationally. And perhaps it's also addressing customer mix. I want to get in this customer. The one thing I've seen is driving it mostly is I want to change my industry.
Yeah, well, I think when you look at this portion of the conversation, you're talking about strategy, and having a defined strategy, and knowing where strategic growth fits. At M. Holland, our bias is organic growth. It's less risky.
Right.
It's less expensive. It's higher return, almost inevitably, and so the question then becomes, where does strategic growth fit? Now, for us, there's two areas we're looking at. One is international expansion. We're distributing for all of these major global petrochemical companies, and there's been a huge consolidation that's occurred there. And also we have the shale oil revolution going on, so there's all this new polyethylene capacity that's coming on stream in the next few years. We think it's essential for us to have conduits to international markets because of this excess resin. So we're working very hard expanding internationally. We've got distribution capability throughout Latin America now, to Africa, to portions of Europe. And then the other area we're looking at is specific markets. As we're looking at our suppliers and their needs, as they're consolidating, they have less resource for internal technical resources and so forth. And so we're trying to fill that hole. So there are certain segments, market segments, where we want to be an extension of those suppliers. So we're looking at some of those specialty areas. We've gotten into automotive through acquisition, but when we looked at automotive, it was a segment where we just really didn't think we could get traction organically. So we went with that. We went with that option of an acquisition. But the acquisitions tend to be a little risky. So let's talk about that a little bit.
Okay.
What are the mistakes people make when they acquire businesses, and then the flip side of that, when they sell their business.
Well, so no matter how much due diligence you do, you really don't know that business until you live in it for a while. And sometimes there's some surprises in there. So I think the biggest thing that people need to know is, what do I really need to get out of this business? If I'm acquiring it, what is my objective that I need to have? What's my timetable to achieve that objective? What is my capability of harvesting that objective? I think that's, you got to have KPIs in there to address that. So when you go in and buy a business, it isn't just saying, well, it's throwing off income. This is why I want to do it. So here's the multiple I want to give it. If you're doing it for strategic purposes, you have to understand what it is that you want to get out of it, because you will be surprised of all the things that you do get with it, some of which you don't really want, and you have to manage that. So, so to me, it's understanding what it is that it's driving it, and then you have to be responsive of. We'll talk a little bit later on, perhaps, in the integration, but in the integration and getting the synergies that you wanted to have, and being flexible enough to deal with the other aspects that come with the transaction.
Yeah, I think one of the biggest mistakes that buyers make is they fall in love with the deal.
Oh.
And even as they're going through due diligence, and even as they're seeing things that aren't right, that are maybe yellow caution lights, they kind of push those aside because they've fallen in love with this deal, and they'll perhaps overpay for it, or they'll agree to things relative to how it's going to be managed post-acquisition that don't make sense. And again, that gets back to strategy. When there are times you acquire a business because it's undermanaged, so you have to be prepared to go in there and make some hard decisions, and so you can't compromise on that. There are times when you buy a business when you need the management team, and you might layer in some earn-out opportunities for that management team, some significant incentives. But when you do that, you're also giving up a certain amount of control. You have to be very respectful of how you account for that business and what control you give them, and that you allow them to run that business to earn those things. So it's having that strategy, as you say, and knowing what you're trying to get out of it from the get-go.
I think part of it too is if it's an add-on transaction, it's different than if it's a platform transaction. So what that means is, if it's a platform, it starts as your base, and you're going to build from that base. And other times, private equity already has the base, and it's adding to that base.
Yeah.
What's that integration? How do we manage that integration? And you have to have a timetable for it. There has to be some integration in there, otherwise it's really not. It's just a consolidation for utilization, and that's not the right way to make money.
You're not getting the strategic synergy.
Yeah.
So what about the other side of the equation? What mistakes do the sellers make when they're selecting someone to sell their business to?
You know, I've been involved in several sales side where I was advising my clients on the sales side and what they're looking at. And actually, I'm surprised at how much money is important, but it's not the highest end item. When you're getting the higher valuation, higher than you thought you were going to get to begin with, they start looking at other things that we want to address. And they talk about, do I want to stay in this business and what's going on? And I want to make certain my team is well taken care of. So I think one of the things that they do come up is, when this sale occurs, if you stay in it, there's a little bit less friction associated with the transition, because any errors or mistakes that they eventually do find, you share in those, albeit at a smaller percentage, but you still share in those. But the biggest mistake I see in some companies that are selling to get out is they assume that once I have this cash chunk coming in, it's all there. There's a lot of reps and warranties that have to be addressed. So when I was talking about my clients not looking at money being a good thing, but not the only thing, reps and warranties become the primary. If you ignore the reps and warranties, you run the risk of being surprised post-transaction of things that you have to give back.
Yeah, you might explain, typically in these deals, a certain portion of the purchase price is put into an escrow account. And then if there is something not right in the business that you said is right, if you've warranted and rep that the working capital is X and you find out a bunch of the receivables are bad, the buyer has a right to claw that back from the escrow account. So that's a good point.
So there's actually three components to that. To go with them quickly. One is when you buy a business, there's normally a working capital adjustment at the date of acquisition, and working capital moves all over the place, so you don't know what that number is, and so there's a true up of that occurs 45 to 90 days afterwards. There's reps and warranties based upon what you assert is being accurate in there. So when the due diligence occurs, they don't have to audit you. They're taking your representations, and they're going to use those representations to support the numbers that you gave them. So if you're fibbing on that, and fibbing's the wrong word, but exaggerating on that, you will be called on the carpet, and you'll have to give some of the money back. So that's part of it. And then the third item is earnouts. And earnouts can occur, and not suggesting that they never occur, but there's oftentimes they certainly don't occur to the level that someone anticipated that they would occur.
Right. I think that for a seller, one of the things they have to be conscious of is who they're selling to, because private equity can be very, very different than a strategic buyer. At M. Holland, for example, we're pretty friendly. We're a family-owned company. We're in it for the long term. The businesses that we acquire, we spend a lot of time on cultural compatibility. That's sort of the first due diligence hurdle for us. And we want to bring people into the family, and we're very respectful of the heritage. And one of the things we try to do at the executive leadership level is always remember that every time we bring in a new business, we have to change too. We can't just dictate and so forth. We have to be respectful of that business model and those relationships and so forth. So we have to constantly remind ourselves we have to be patient. We have to learn and so forth. Private equity can be a much harsher master, and not bad, but you have to remember when you're selling to private equity, the private equity partners have a couple of objectives. One is making sure they're growing your business and creating value. The other one, though, is serving their investors, and sometimes there's a conflict between those, and it can be a harsh reality for particularly entrepreneurs who've never worked in a lot of places and been through that.
So I want to give kudos to M. Holland. Pat McCune gave a presentation at the Plastics News Financial Summit last month in Chicago, and it was an awesome outline of the culture and the deliberate culture that M. Holland is looking to create and have and export to the various acquisitions that you do have. That's something that's of value to someone who, when you go out to buy someone, hey, I know who you are. This is good. I'm interested in joining your team. So that's a positive. Private equity, or I call them professional gamblers. They're all type A individuals.
The 100-day plan.
The 100-day plan.
Everywhere you get your 100-day plan, yeah.
Yes. So they go into it. They have very strong expectations, and they do pay a premium. If they're going to pay a premium, here's the other thing you have to remember. If you're selling your company for a premium, don't expect it to stay the same, because they have to get that paid back one way or another. And so they see something in your company that says, what you have, you're not utilizing to the highest level of capacity or use that you can have. And so when we acquire you, we're going to change it so we can maximize that value proposition. And so there's going to be a change,
Yeah.
and there's accountability. It's one thing that private equity is very, very good at, is making you accountable.
Yeah, when they get to that 5 to 7, typically private equity firm will form a fund. It'll typically be about a 10-year sort of life. And years 5, 7 is when they want to start monetizing. And when they're ready to start monetizing, it can put the pressure on. Another thing that's common with private equity is they're not afraid of leverage. I was talking to a friend who sold his business and he was doing well in a private equity situation, but he said the one thing about this is they're not afraid of debt. So he was working a lot for the bank at the time. So.
Well, to that end, here's the other thing. If you stay in the business, you're selling and you're going to stay in, it's a huge difference, because these companies that are profitable, and that's why they're attractive, they're highly profitable. They may not have any debt. They have very limited debt.
Right.
Cash flow management's easy for them. Then they turn around and sell it for millions of dollars with millions of dollars of debt attached to it. And now they have debt covenants they have to address, cash flow planning that has to be done. These are new things they haven't ever addressed in the past, and that's another surprise that a buyer may or seller may have.
And it's important to point out that doesn't make that model bad.
Nope.
Because you can make huge money when you're a participant as an equity owner in this highly leveraged business. So that doesn't make it bad. And I think the other thing in discussing private equity, we talk about it as though it's sort of one monolithic fund. And in fact, there are almost 2,000 private equity firms in the U.S., and they vary all over. There are family, wealthy families who've created funds that are much more patient. So it just depends, and there are funds that do nothing but fund startups, and there are funds that deal with early stage businesses, trying to take them from 5 million to 20 million, and so it's a very diverse industry. But I do think that for a seller, they want to go into conversations with their eyes wide open, because life will change.
Yes. Well, that was on a couple of recent transactions. One of the considerations that my clients had in selling to a specific private equity, for instance, was, did I like them?
Yeah.
And I'm not even sticking around. I'm the owner. I'm not going to stick around. Will my employees like them? Because the last thing I want to be known for is a guy who just sold them down the river.
Yeah.
So they look at that as saying that's something of import. They will look at the personalities. They do background checks on the private equity. What other portfolio companies do you have? And let me talk to them.
That is so important when we're looking at a potential acquisition. One of the conversations we have is, look, you do your due diligence on us. This has to work both ways, because again, cultural compatibility is really important, and we want to keep these people. We've done 5 deals in the last 4 years, and those seller owners are all with us now in key management positions, and we're very proud of that. And we celebrate the heritage of their businesses. We created what we call a Founders Hall, which is a digital history of each of these companies, so that we don't lose those legacies. They become part of the overall M. Holland legacy. But I think a seller has to be really conscious of their legacy, because their legacy will be what happened to that business after the sale. Another thing a seller has to be mindful of is, as you say, the payout might be less than they anticipated if there's earnouts and so forth, and there might be clawbacks from reps and warranties. In addition to that, they're typically going to get a big tax hit. And so you go into this thing thinking, man, I'm going to make $10 million on this, and you find out that the real amount is $5 million, and then you say, well, gee, I've got to invest that. Where can I invest that? Well, I may not be able to invest that anywhere to get the return I can get by keeping my business, and at the end of the next 5 or 10 years, I still got my business. So a lot of things to consider when you're looking at selling your business.
Yeah, so someone who's 40 years old looking to sell their business, they have that issue to deal with, and where are they going to go? Someone who's 60 to 70 years old, It's a transition. It's a retirement thing, and so I think at the station in life that you're at,
It's
how much
huge.
energy you want to put into it and continue to put into it is a driver as to whether you will sell or not sell.
Yeah.
If someone comes to you and says, "I'll give you a huge amount of money," yeah, maybe I'd do that and go do something different, but I'm going to still do something.
Yeah.
But some of these companies that we're looking at now, the baby boomers that are selling off, and I'm a baby boomer. I'm at the end of the baby boomer generation, and there we go. It is, their idea of what they want to do going forward is do I have someone at which to sell it to?
Yeah.
And what can they do with it? So one of the interesting things about private equity is, or selling to another strategic buyers, I'm joining a bigger team.
Right.
I'm going into a bigger team. I can make this, hopefully this legacy will perpetuate itself into something else and be
Yeah.
part of something else, something bigger. So there's some of that goes into that. And I won't consider that all ego, because some of it might be, but a lot of it is really just concern.
Yeah, I had my own business and sold it to Tecmer in 2008, and Tecmer's a great company. I will say this: I slept much better having sold that business than I did when there's no safety net when you're the owner of a business.
That's correct.
So you worry about everything. Let's turn a little bit and talk just briefly about international.
Right.
Because there's a couple aspects of this. There are the U.S., particularly the U.S. plastics industry, is going through a bit of a renaissance right now, and we expect that to continue. So in all likelihood, we're going to see a lot of M&A interest in the industry for some time to come. Some of that's coming from foreign buyers.
Mm-hmm.
So one aspect of this is what it's like to work for a foreign company. The other is if I'm a U.S. business that has a strategic need to expand beyond the United States, what are some of the risks and pitfalls of that, and how do you mitigate those?
Well, so let's talk first about the opportunities. And oftentimes we want to go internationally for following a customer, and we're a customer intimacy approach to things, and it's a way for us to stay close to that customer and still serve them from another country. Also, we might be doing it for lower cost. It might be one of those things to address the cost structure that we have, or just to have that option available when you were dealing with customers on what is my cost structure and options that's available to that customer. So there's reasons why I want to get into it and want to go to like Mexico, for instance, or other countries. I just had a couple companies, my clients buy companies in Canada and in Mexico, and they're completely different. But the strategy why they wanted to do it was based upon customer presence. The risks I found to be very interesting is, number one, there's certain tax risks that you got to be aware of, and if you're not aware of, it can come back to haunt you pretty good, both in the company of the United States as well as the country that you're going to. And you got to be prepared. Do not do this without having someone helping you understand what those requirements are, risks are associated with that. But culture is also a huge item. Between Canada and the United States, it's very similar, but the cultures in Mexico and the United States, and you can talk about other countries as well, they're different, and you can't assume they're going to operate the same. Just as someone coming inbound to the United States and buying a company in the United States can't assume it's going to operate, Chinese company buying company here is going to assume it's going to operate like a Chinese company does. It won't. And so you have to adjust that aspect. So I think you need to do a lot of homework before you go into another country and address that.
Yeah, I think, again, you have to have a good strategic reason to go internationally because the risks are much higher. We so take for granted in the United States how easy it is to do business. We have
One language,
one
currency.
language. We have the leading currency in the world. We have the huge diverse marketplace. We have relatively stable laws and rules and methods of doing business, and relative to many places of the world, a highly ethical business environment.
Correct.
When you move beyond the United States, you have to recognize that this is a multidimensional thing you have to manage. And in our case, what we look for, and we did a partnership down in Mexico about 2 years ago, and it was very important for us to find a partner, someone who knows how to maneuver through all of those shoals that
Yes.
that can bite you. We're really grateful that we've got a trusted partner because the complexities of doing business, even in Mexico, which is, a very mature, developed country relative to certain other Latin American countries, and when you go to Africa and so forth. So we found that one way to mitigate the risks and make sure that you're on the right track is to make sure you've got a trusted partner.
I couldn't agree more, and I think it's risky buying any business. Doing a business that is, 1,000 miles away, different language, different laws, different customs. So when I talk about customs, I'm not talking about border customs. I'm talking about the cultural customs.
Yeah.
They're in play, and what's the right way to treat the employees? What's the right way to engage in commerce in that country? You need to know those things because it could be a rude awakening. I have had a client that went into China, says I got into really cheap. I only had to spend $700,000. He was out within a year.
Yeah.
So that's $700,000 that he got in cheap, but he got out fast.
Yeah. Let's turn to due diligence.
Yeah.
So you get involved in a lot of the due diligence
Yes.
activities. What are the critical areas where you would need to bring in outsiders to help you, and where would you want to use your internal people? How do you recommend companies approach due diligence?
Well, so first of all, just a word to the owners out there that are putting their company up for sale: clean your house up. Get it cleaned up a year or two in advance, at least a year in advance. It should be 2 years to 3 years in advance. What does clean your house up mean? It means having really good inventory that's you can count and verify that's there, and not have a lot of stuff that just carried over. Same with receivables. To segregate your personal assets from your business assets. Make certain you the more stories you have that you have to describe in your confidential information memorandum, otherwise known as a SIM, the more stories you have, the less value you get. The cleaner the story, the better the value. And so that's doing, cleaning house up front. So that would be number one. Some of the areas that we find that we need to bring in other people, frankly, it deals with, sometimes customer concentration is really, really significant. We might have, I've been in a couple transactions where it's 90% of the business is with one customer. Wow. I gotta know if that customer's, what that customer's financial footing is. How long are they gonna stay around? What is our relationship with that customer? That kind of due diligence and understanding that intimacy that we have with that customer, how sticky is it, is imperative in the value of the company. So there you may need to have someone to understand that customer and address that customer. Tax laws, addressing various tax laws, and there's this thing called pedimentos in Mexico, and make sure that that's up to date and there's no unstated errors or valuation issues. And I was on another transaction, this is a few years ago, but it was $3 million of unreconciled VAT tax and impedimentas, and that was a deal issue.
Yeah.
So that deal issue said, I got to reduce the value.
Mm-hmm.
Well, they're saying it's not going to be that much. We can fix that. Well, that's where you have to fix up front.
Yeah.
Get it clean.
And that's where a buyer can fall in love with a deal and run the risk of just accepting that and say, oh, okay, and wind up getting bitten later. Yeah.
But I say the momentum carries deals both ways.
Yeah.
Both for the buyer and
And
the
the
seller.
seller. You can fall in love with it. Yeah.
Because there's a lot of pain and suffering. Here's the other thing you have to let people know is when you're selling your company, it's a lot of work. Do not expect that someone's going to come in, you're just going to set up a data room. You're answering questions for months.
Yeah, it's a huge distraction.
It's a huge distraction. You better have assets and resources available to supply that. And frankly, investment bankers do a really good job of organizing you, addressing that situation, and clarifying and making certain it's not going sideways when it needs to go sideways, getting the seller back on board as to why you're selling it and what the purpose is, as well as also talking to the other side. I think an investment banker offers a really good purpose here in making the transaction happen, because there's a lot of reasons why a transaction won't happen. Now, frankly, they carry the momentum. They push momentum, so they're
sure. They've got an incentive to,
they don't get paid much without that deal closing. But having said that, they manage a lot of that noise that we're talking about that needs to be addressed.
Well, from a buyer's perspective, we view the due diligence process as the beginning of the integration.
Okay.
So, in my mind, there's a few areas you want to have really, really good outside counsel involved. One is your finance and taxes. One is legal, including environmental. And then you probably want to have outside help on some of the other financial matters you've got to dig into and do some auditing in. I want our people involved when it gets down to the operation side of it.
Yeah.
And the people side of it is huge. I mean, you really want to know the people get to know the people that are joining your team during that due diligence process. And that can take one of the risks of due diligence is it can create a real adversarial environment between buyer and seller. And so you want to approach this, as part of the negotiation. You want to deal with issues above board. You want to be very honest. You want to have a real effort to find common ground when issues develop. So we kind of view the due diligence process as the beginning of the integration, and it gives you a real head start. If everybody knows it, if your finance guy knows their finance guy, and if your ops guy knows their ops guy, it gives you a real head start because it all comes down to people and relationships at the end of the day.
So to that end, it's not only just knowing those people and from a personal level, but it's also knowing the processes they have intimately. So because the financial due diligence is only going to go so far.
Right.
All right. So, but when it comes down to the language, is what is productivity? How do you define productivity? How do you define setup time? How do you define schedule attainment? How do you define, just anything out there? How do you find scrap?
Yeah.
So all those things, there's a huge gap and variance between the highs and the lows associated with that. That's where it's understanding where they're coming from and how they're addressing it to see if it fits what you're going to do going forward. Those little things having common language is one of the first things I think will help in melding cultures together.
This is a great segue to integration because this concept of language, every company has its own language. M. Holland, we are guilty of having more acronyms than you can imagine. I mean, we literally should have a dictionary, and we've even talked about it for acquisitions. Here's a dictionary of what all these acronyms mean. But let's talk about integration and how you do it and the importance of it. Maybe you could comment.
Well, and that gets with the I will say if strategic buyer, the integration is really important. If it's a financial buyer, it's a platform, the integration is really on the finance side of things and understanding how the finance and the reporting, the governance and the reporting, we talked about that. So you're talking to private equity, the metrics that they need to have, and how frequent do you need to have it, and the accuracy. You want to destroy some of your goodwill is just having bad reports going out a couple of times, and you destroyed some goodwill with the new owner. But on a strategic, I think the integration is key to making it work. Value is enhanced with synergy. If there's no synergy, well, then they're just two separate entities. We can keep them two separate ones, and they're fine to have separate. But you're not going to get you're not going to get the premium you paid for that, because there is a premium, unless you're buying something that's on a turnaround status. And we didn't talk about turnaround acquisitions, but right now it's premium buys. And that integration, you need to have it from a strategic standpoint. On the turnaround acquisition, that integration plan is, how do I fix this thing? It was
Quickly.
broken.
Right.
I'm going to fix it now. I'm going to fix it based upon certain aspects I'm going after and addressing, and you got to know those things. And it's very operationally driven.
And in those situations, you want your due diligence to be identifying those steps you need to take very quickly, because you typically don't have a lot of time to waste.
Right.
If a company's bleeding, you want to make sure you staunch the.
And there are certain private equities that love turnarounds, and they're
very good at it.
They're very good at it.
Yeah. So.
Don't expect them to be loving and warming.
No. So from our perspective, the integration, we try to run it in a very disciplined manner. So we will have a long list of integration things that have to occur, and we will have an integration team, which will be functional people from the organization. HR will have, and they'll have certain tasks, and we'll have ETAs, and we will meet on initially, generally weekly, and it'll be the team will include people from the acquisition as well as from the center, and we will go through as a group that list on a weekly basis, and then once you make some progress and you start to check off the assignments, you can then extend that more to a monthly basis, and until you finally get into a point where you can leave that. From a corporate development standpoint, my office is responsible for that integration process.
Do you stay involved through the?
Absolutely, because when you acquire a business, that acquisition needs a champion. You throw yourself into the situation where you're suddenly being bought by a big company, and you have HR people asking you for stuff, and you have the operations team asking why you do it this way, and you're trying to integrate some things. In our case, maybe common warehouses and so forth. So you're imposing all of this change during the integration, and you need someone that they know, and that's typically going to be me, because I'm involved in the acquisition and the negotiation. But you want a champion who will be able to sort of balance that and say, hey, look, HR, we're killing them here, or
yes,
this is why they do it
right.
this way. So they need that advocate until they get to know the rest of the team, and until they build those interpersonal relationships and you start to get that functional harmony. You do need someone to be that champion, and it's always helpful to have someone who's been there. And I've been on both sides of it. I've been on the selling side of deals and on the buying side of deals, so I can see it from both perspectives. Now, my job is to work myself out and move on to the next one. So I don't want to own these things, but we do stay very involved, the corporate development group, and we coordinate all that activity and make sure it's happening.
One of the things I was going to bring up too is when you're buying a company, you're bringing it in. It's a strategic acquisition. You do it for strategic purposes, and here's what we're going to get out of it. you have to acknowledge the increased level of complexity that you just innately brought into your company. How many different nameplates do you have on press equipment? How many ERP systems do you have? How are you managing how many new customers that you have to bring on and address that may have different rules and regulations and terms and conditions?
And branding. I mean, branding becomes a whole area. How do you change the name? What's the goodwill in the name? What
Yep.
about product names, product numbering systems? Yeah, the complexity, the integration process, you really need to manage it to the finest detail
Right.
to do it properly.
But we do find culture or people issues make a lot more noise than ERP systems and dealing with multiple nameplates on your primary equipment. That part's the easy part.
Yeah.
So it is going to be something for us to that a company will need to address and recognize it.
Yeah.
All of it's important. The loudest squeaky wheel is going to be personnel issues addressing
Yeah.
this.
Yeah, I guess my final comment on acquisitions is the only one that can hurt you is the one you make. You wanna really think hard when you're buying or selling a business. It's kind of a one-time event, and you want to make sure that it's right, and never be afraid to walk away if you're getting the feeling that it's not right.
So that gets into here's the other side. When do you know it's right time to sell? And so those are things that some of my clients look at, and I think that issue when to address that is years in advance. We talked about cleaning up the balance sheet and keeping things clean ahead of time, but if you have customer concentration, you got seasonality, those are negatives to valuation. If you have a core competence, do you have a patent on it or a trademark, or have you gone to protect it in some form or fashion? Getting your team set up appropriately. The wrong time to invest in a new facility and a new ERP systems just before you're looking to sell their company.
Yeah, right.
So you want to get that stuff done ahead of time, so it's not there. So it's not a story that detracts from the value of the company.
Mm-hmm.
And because they will take the ERP system that comes with it, but all the costs that you incurred is going to be expense in that year, and it's going to be a negative or drain on your valuation. So those things, you need to plan those out. If you're interested, if you're 55 now, and you're interested to sell by the time you're 65,
Start planning now.
start planning now.
Yeah.
Just figure out how you're going to get there and what you need to do. Not only having those plans in place, because you'll be surprised how many times you have to revise those plans. Things happen, people leave that you're counting on, new customer came on, old customer left.
Right.
All
Right.
that stuff needs to be revised in there. That's why you need that extra 5 years. It takes you 5 years to get it there if there's nothing wrong.
What about the time to get a transaction done? What's your experience? And because you got to deal with all of this due diligence at the same time, try to run the business and hope no shoe drops. That's gonna,
The fastest one I've ever seen was 3 months, and that was a distress deal. So distress, yes, those happen really quickly. Typically, we're seeing 9 months or longer, and so by the time you select your investment banker, there's a process there that you're addressing that. I'm assuming you're going to an investment banker. You may not, but if you're not going to an investment banker, your team, because you need a team
right.
to support you. By the time you select that team to support you, by the time they put together the SIM, the Confidential Information Memorandum, which is I have to give investment bankers credit. They make every company look really, really good based upon the SIM. I mean, everything walks on water.
Those take a lot of work too.
And they take a lot of work. So they do a good job of bringing out the pretty aspect of the company. in addressing it. If they have to do a little bit of extra work on that, that may take some time.
Yeah.
But SIMs could take 2 to 3 months
Oh,
all by
sure.
themselves.
Yeah, well, they have to do their due diligence as well. So, questions from the...
Yes. Thank you, Dwight.
viewing
Thank you,
audience.
Jeff. We're going to take a few questions from the audience now. How many more consolidations do you expect to see in the near term among resin producers or large processors?
I can speak, I think, to the resin producer side. We think they're going to continue. I mean, if you look at how many, these are mega deals now because most of these players are huge. And many of them are, have sovereign ownership, so that can complicate things. But I would say that we see continued consolidation at the global level among these players. And I'm not going to get specific, but there's a couple that, Dow DuPont is in play. Huntsman Clariant that deal's being challenged, but we think that trend is going to continue and will continue to drive consolidation at the distribution level. What about the major processors?
In the processors, I would say the more commoditized the product is, the more pressure is for consolidation. So certain packaging products would be more towards the consolidation phase of things. But the plastics industry is so niche. There's such a variety of processes and resins that you're working with that to think that you're gonna get better utilization by bringing a whole bunch of these companies together that have very unique core competencies is probably not going to happen. So I see that's the fallacy of the mid-90s consolidation phase. I see them staying fragmented in that regard, being very niched.
Yeah.
So what you might see is that barbell approach.
Yeah.
Some of the bigger ones getting bigger, and some of the smaller ones staying in that niche and being focused on being very effective at processing that resin or that product.
Okay, another question from the audience. How difficult is it to conduct succession planning to sustain business instead of selling it, and what are the pros and cons?
Well, if I have a family business and can perpetuate it over generations, I'm going to do it. I think that a great business is not only provides a super income, but it holds a family together. And there are ways to keep a family business even if you don't have that succession leadership. You can set up family trust. You can bring in professional management. There are many examples of companies that have had family ownership. Well, Ford Motor Company is still controlled by the Ford family. So I don't think just selling the business is the only exit for someone who wants to perpetuate their legacy and keep a family business.
And I've worked with companies on succession issues and helping them try to prepare their son or daughter to take over the business. Some have done it very well, and others had agonizing. The reason why we were brought in is they didn't think their offspring had it in them to do it, and it was going to put their retirement at risk, and so they wanted someone else to deliver the news versus them saying it was.
Makes for an interesting holiday next go around.
It really does. So that does occur, and it is one of those things that it changes the family dynamics, makes it very difficult in that regard. But succession is a huge item. It doesn't just have to be family. Succession to the next level of management. Every company should be dealing with succession.
Yep.
Okay, final question from the audience. What is the most affordable method for a small or mid-sized company to conduct a sale without incurring huge consulting fees?
Well, there are a variety of business brokers out there, and there are some that will work for a lot less money, or if you have a natural network, and there are practicing attorneys who make sort of the small deal their practice, and they often will also have sort of they call it a widow's doctor's network of investors that can help you monetize your investment. Another way is to use your own personal network to find that buyer. But there is expense involved, and you got to be careful. You don't be penny wise and pound foolish, because you can make mistakes without proper counsel.
And all I can say is I agree 100%.
Okay, we want to thank our presenters for their engaging conversation. We've certainly delved deeply into the higher stakes world of M&A and when it makes good strategic sense for a company to consider. We also appreciate your attendance at this fireside chat, once again fueled by M. Holland and produced by Plastics News. If you want to revisit this chat, the entire event will be archived on the live stream/webinar section of plasticsnews.com. Look for more information from Plastics News on the next fireside chat taking place on August 30th on how digital changes everything. Thank you again, and we'll see you at a future fireside chat.